Hey everybody, I got a quick update on the safe investing world. Interest rates continue to go up and we need some historic perspective on this. So I'm going to share my screen real quick and make sure that we understand where we're at on this. All right. So the safe investing world is rapidly changing and we need to keep an eye on things because we don't know how long interest rates will continue to go up, but we do know they are going up. At least in the short term, they're going to continue to go up. So a little bit of a historic perspective. The federal discount rate hit its high in 1981 at 14%. Okay. We're currently only at 3.25. So if you feel interest rates are high right now, I can assure you they can go significantly higher. We have to understand that difference. It becomes really important for us having that perspective. They can continue going up and they can continue going up for a long time. Do I think they really will? Well, I'm not sure about that. I think we push until it breaks, but when does it break? We don't know. We have a lot of federal debt tied to these interest rates, and we got to be careful about how high we push them. I think there's some political games going on behind the scenes. There's a lot of other stuff involved in raising interest rates, not just combating inflation. So the other part of this is understanding that the low interest rates we've been through, okay? The highest interest rate between 2008 and 2019, more than a decade, was only 3%, and the vast majority of that time it was only at 0.5%. It was below a full percent. We spent the majority of that time. It was only till 2019, right in July 2019, that we hit that 3% mark on the federal funds rate. So really, we're not much higher than we were back in 2019. Seems a little strange, doesn't it? We're at 3.25 right now, whereas 2019 July we were at 3%. Then we look at that decade between, or not decade, sorry, couple of years as that pandemic hit. So January 2020, before really the whole panic set in of the pandemic, we slammed interest rates down, and we're looking at a 0.45% interest rate between January of 2020 through August of 2021. So we've had extremely low interest rates. So we need to understand, for the decades of time that we've seen interest rates just consistently going down, which in all reality, you look at the charts, we're talking from 1981 all the way to 2020. That is literally, 4 decades, 40 years. That's most of our lives, okay? At least it's the vast majority of our investing lives. This is the world that we understand and we know. It's where our brains are. It's how we learned how to invest in an environment where interest rates continue down. So we have to understand, when we lock into fixed interest rates, the value of those investments goes up as interest rates go down. Whether it's a bond, a CD, or any other type of fixed interest rate, if you lock in at 10% interest and 5 years later interest rates are only 2%, everybody's envious of your 10% interest rate and would pay you lots of money for it. So that's why portfolios were stabilized using bonds. Okay, it makes complete sense. We've done it for 4 decades. Bonds, stabilized portfolios. It's the safe investment of choice. It diversifies you from the stock market turbulence. Okay, but this only works in decades or years when interest rates goes down. When we turn and start raising interest rates, the value of those bonds or those fixed interest rate investments goes down and down and down as interest rates rise. So we saw this for 40 years, back from 1945 to 81. Interest rates consistently went up and up and up and up, and the use of bonds was almost non-existent. Okay? Because the value of your investment decreases. If I go buy a 2% bond right now, or a 2% fixed interest rate for 10 years, and 5 years later, the interest rates are 10%. Who wants that 2% investment I have? I can't sell it. Nobody wants to buy it from me. Okay? So we don't want to be in fixed interest rates as interest rates are rising. Fixed interest rates are great when interest rates are falling. Okay? So now we have this concept of rising interest rates, 2020 on up to when? We don't know. We don't know how long interest rates are going to go up. We might just see them flounder sideways, try to go up, fall apart, try to go up, fall apart. But what I can tell you is we are still in very low interest rate times. Okay? When we look at the big picture, we have very low interest rates still. And the room for them to go up is much more than the room for them to go down. So locking into fixed interest rates is a difficult proposition in the grand scheme of things. So we do have to be very careful of that. So let's take a look at what these fixed interest rates are offering out there right now. So let's start with the treasuries, okay? Pretty flat straight across the board, 1 year, 3 year, 5 year, 10 year, all pretty much the same, okay? When we talk about treasury bonds, bills, all these types of things, for the most part, okay, if you want out, if you want your money, you're going to have to sell at the market or take a penalty, okay? All the treasury investments typically are going to charge you a penalty if you're allowed to redeem them within the first 5 years, okay? The rest of them, you have to find somebody to buy from you. So again, locking into a fixed interest rate, if it's market-based when you go to get your money back, then you're going to worry about interest rates raising. Okay, so for the most part, when we're talking year plus investments with the Federal Reserve, then we're talking about market-based liquidity, meaning interest rates rise, you're going to lose money. We get paid simple interest in these things. Most of the tools there are going to be simple interest, especially when we're talking about the years. Okay, and no, there's traditionally no fees in those treasuries unless your broker is buying them for you or you've got an advisor buying them from you and they've got their management fees. Okay, then we look at the AAA bonds. You know, AA, AAA, I consider all those fairly safe. But again, when we think about bonds, those are traditionally much longer investments. You know, people get scared of a CD that's 5 years. Well, bonds are usually issued at 30 years. There's even 100-year bonds out there. And actually, I think there was an issue of 300-year bonds. This doesn't make any sense. So the bonds are a bit of a different market, but you'll notice when you look at the 3, 5, and 10-year market, the interest rates are actually very similar to the treasuries because interest rates are moving so much. The longer term are much more market-based, whereas the shorter term are what the feds are pushing and pushing and pushing, trying to get the shorter end up, okay? The longer end is really more the market-based. They're influencing short-term, which in turn, over time, influences the longer-term in interest rates out there. So AAA corporate bond world, you're looking at the short term still making a whole lot of nothing. So your short-term bond funds, things like that, they're paying very little compared to what else you can get out there. So it used to be, let's do the short-term bond funds because we don't like being in the long term as interest rates are rising. Well, you're missing out. Short-term bond funds don't make a huge amount of sense right now. Then you look at the longer term, you start going to the 3-year side and 5 and 10 year, and you're doing much better. Okay, but again, our problem with these is they're market-based. If you need your money, if interest rates have risen since you purchased, you're going to lose money. And if we're looking at these for safe investments, we got to be careful. But the biggest problem I have is if you're trying to protect yourself against inflation, never lock into a long-term fixed interest rate. Okay, because the Fed's toolbox says we got to raise interest rates to combat inflation, which means you're losing money in your safe investment. They don't make sense if you're worried about keeping up with inflation. Okay, be very careful about these longer term fixed interest rates. Fixed interest rates end up devaluing as the interest rates in the market rise. Then the other side of this is CDs. Oh, and by the way, on these bonds, understand that these are your returns before fees. If you have to take fees out, if you've got an advisor or a mutual fund taking fees. You're not making this 4% anymore. We have to keep this into perspective. I'd rather go buy treasuries with no fees than buy bonds with fees right now. Okay. It's a weird time right now. Bonds have not a huge amount of value on the market at the moment. But a lot of us, especially in 401ks, things like that, we really don't have any other choice. If we're risk adverse, or we're trying to get ready for retirement, or we have a need for safe investments, boy, some of us don't have a way to stay away from these bonds. It's our only choice. And that's the problem with our investing world, is we've been relying on these bonds as safe investments for 40 years, and they've worked just fine. But that does not mean they work forever in the future. It's all based on interest rates. So we got to be so careful. You look at the CDs, in some cases, these CDs are beating bonds. If you're faced with a 5-year CD making 4.6 or 4.9, or a 5-year bond making 4.6, you take that CD every single day of the week. Okay. And some of the brokerage CDs, they are actually market based, meaning you can go sell that CD. If you have a 5-year CD and you only want it for 2 years, you can go find the market and sell it. Okay. So in some cases, you can actually turn around and sell these. But for the most part, CDs, if you try to cash them in early or take any money out of them, you're limited to the interest in most cases. Otherwise, you have to pay penalties and fees. But again, notice all of these are simple interest. All of these are simple interest. Compound interest pays interest on top of interest. And when you look at anything beyond that 1 year, simple interest is far inferior. Okay, far inferior to compound interest. The calculations become astronomical the further you go. If you get to 5 years and a simple interest compared to compound interest, we're talking several percent difference in returns. Okay, so then you go to this fixed annuity world, which a lot of people, these have become incredibly popular. People are realizing that these are just CDs from insurance companies. The funny thing is, banks have been selling these. They've been the #1 seller of fixed annuities in the United States for a couple of years now. Okay. Well, they're far better. Just to be real honest, it's just they have the stigma of this word annuity. You have big brokerage houses selling you against annuities. You got Fisher out there telling you all annuities are evil. And even the banks will tell you, no, don't do an annuity because you got to buy our CD, until they change their tune and start selling those fixed annuities instead of their own CDs. It's amazing the stigma that the word annuity comes with, and it's unfounded. To be real honest, yes, we have some salesmen selling annuities to people that have no need for them. Yes, that's how they get their bad name. It's understandable, but the industry has pushed back from these annuities forever, and now we're relying on them. Okay, because they're far better investments. Not only are they paying more interest, but that interest is compound. On top of the fact that they're not market-based, meaning if you need to access this money, you have access to 10% of it. If you need more than that, sure, you're going to pay a penalty, but you're going to pay that penalty in any other fixed rate investment as well. Okay. Sitting around in 1 year investments year over year over year. Okay. That's an alternative. That is a choice, but you're always historically pushing yourself into lower interest rates. Whereas these fixed annuities pay compound interest, which is a huge advantage. And you have access to 10%. So if you can live within that 10% access, this ends up being a much better investment, and it's not market-based. We don't have to worry about interest rates rising, right? We can just take our 10% out every year and reinvest it somewhere else if we need to, okay? And we don't have to worry about selling at a loss on the market-based, okay? And no, there should be no fees. That's another misnomer about the word annuity. Most annuities actually don't have fees. Okay. So let's talk about the one other alternative. And I'm going to break up this screen. There we go. I'm going to bring you in here because I want to play with the numbers here. A lot of people don't understand these fixed indexed annuities. Okay. Fixed indexed annuities are fixed annuities. but they give you more than one way to earn interest. So when we talk about not wanting to lock into longer term fixed interest rates, this is a great alternative because it gives you other ways to earn interest. You can use it as a fixed annuity, but you can also choose to index it to the stock market with no risk. Okay. Now, this is very interesting because a lot of people hear that and say, well, that's too good to be true, but it's really not. There is no risk. By regulation, these cannot lose anything, any money when you're tied to this market. Okay, by regulation, you can't lose your money. So it's not like they're going to pay you, if the S&P 500 goes up 50%, they're going to pay you 50%. That's not how this works. They tie you to lower volatility stock indices. They're using hedging and corporate lending really in their portfolio. Okay, so on the left here, this is the S&P 500 from 1999 to 2021. You got 9/11, you got 2008, you got the 2015 kind of flounder, as I call it. 2018, at the end of the year, it plummeted, but then started coming right back. So we've had lots of ups and downs in here for the last couple of decades. Okay, if we invested $100,000 in the S&P 500 back in 1999, it would have gone up, it would have gone down, it would have gone up, and ultimately we have $391,000. Okay, so 100 grand turned into $391,000 sitting in the S&P 500. Well, if I just sat back and earned 3.5%, which over the last couple of decades, 3.5% was actually pretty darn good, you can see I would have only had 220. So there's the blue line there. In a fixed annuity or a CD or a bond, we would have had right about 220,000. So it looked good for a little while through the turbulence, but in the skyrocket, boy, we did so much better in the S&P 500, right? All right. So the cool thing about a fixed indexed annuity is that we don't have to sit in there. I'm going to flip this into a spreadsheet here, and I'm going to change the allocation. Every year, we're allowed to change how we earn interest in a fixed indexed annuity. And we have access to 10% of the money every year, okay? So what if I want to index it to the stock market? Let's say I'm going to do 50% in the S&P, Standard & Poor's multi-asset stock index, okay? So Standard & Poor's came up with a multi-asset stock index. Fidelity's got a stock index. Let's just put 30 in there. And BlackRock has their socially responsible index that's been under fire right now. But the reality is it's still a good stock index. It didn't exist in these years. So I'm actually averaging in zeros when the whole idea of socially responsible investing didn't even exist. So I'm just putting zeros in there. Okay, I'm just imagining they earn nothing those years. So I've got 50% in the multi-asset, 50% in Fidelity, and 50% in BlackRock. And here's what my returns would have been each year. So when the market goes down, I don't lose anything. I might not make anything. Here's 2015. Pretty much all assets were kind of flat and done and not really doing much in 2015, and we earned nothing. 2018, the crash at the end of the year, pretty much every index went down that year. Okay, so there we are at zero. We earn nothing some of these years. We earn 0.72 some of these years. But boy, look at some of these years when we earned 18, we earned 14, we earned 11. Okay, so we're not lighting the world on fire, but some years we make up for not doing well. And look at our performance. The S&P 500's at 391,000, and we have $449,000 in there with no risk and no fees. Okay, so when somebody brags to me that their portfolio earned 80% last year, I'm always looking at them going, yeah, but how much did you lose the year before that? And what do you have to make up? You look at the losses, you got several years to make up those losses. 2008, it took people 4 to 6 years to make up for those losses, okay? You look at the pandemic, it was a heck of a lot quicker. It doesn't even really show on here. It shows that 2020 was up 15% because the market went down so fast and came right back so fast that the yearly number doesn't even look like anything happened. It's amazing the turbulence that we've gone through that doesn't even really show up on the yearly numbers. So the fixed indexed annuity ends up being a great solution for people that want safe investments. Now, you can't pull money out unless you're over 59 and a half, or it's IRA and then you're shifting it around. But for the most part, annuities are only for people that are over 59 and a half or don't need the money until they're 59 and a half. Okay, it's considered a retirement vehicle. So that's why a lot of younger people don't know anything about it, or maybe you haven't learned anything about them until later in life. So there is a stigma on the word annuity, but the reality is these are far better, okay? So let's do one more thing here. Especially for these retirees. Let's say we just don't want all of it tied to the market. So let's say we put 50% in the S&P multi-asset and 50% in the fixed interest rate. Now, the stock market performance ultimately was better, okay? Slightly better, 391 versus 332. Wonderful, but we didn't have to go through all the turbulence. But here's the core competence of a fixed indexed annuity. They are meant to be used. So for instance, what if you had required distributions and you wanted to use this in an IRA? You can put this in your IRA. It's no different than a stock or a bond or any other investment. You can put this in any part of your portfolio that you want. So let's say we're going to do a 4% withdrawal rate. Okay, we're going to pull 4% out each year. Look at what happened to the performance. The more you're withdrawing, the more a stable investment will outperform the market. Okay, if you want to build wealth, the market is the most reliable place. If you want to withdraw wealth, stable, safe investments like fixed indexed annuities blow away any volatile portfolio over time, period, without question, without hesitation. The more you withdraw, the greater this disparity is. The blue line is the fixed indexed annuities performance. The red line is the S&P 500. Again, mind you, with no fees. So if you've got an advisor pulling fees, if you're in a mutual fund, that creates even more of a problem. So notice, let's say we just do a 1% withdrawal. Well, the stock market still beats us. So now we're going to do a 2% withdrawal. Oop, the fixed indexed annuity now starts winning. 3% withdrawal. Even bigger win. 4% withdrawal, which again, your required distribution starts just under 4%, but gets bigger and bigger and bigger and bigger every single year. So 4% is a good average for the first decade of required distributions. And it's amazing. The more you're withdrawing, the bigger the gap gets. You need stable investments when you're withdrawing money. That is your number one priority. And that's why I'm such an advocate of these fixed indexed annuities. The great thing that's happening in the industry is that these are guaranteed for term. They can't change these interest rates, but you can change how you're earning interest year to year to year. So right now, when everybody seems to think the market's going to be down a year from now, you can sit back and earn 3.5%. But when you have a little more confidence in the market, you can put it in the indexing. And if the market goes up, you're going to earn a lot more. Okay, so these fixed indexed annuities, please understand that there is a stigma about the word annuity, but it's a stigma. And there's a reason that stigma was created, because the last 40 years, bonds have been a superior, safe investment. But the reality is, for the last decade, these fixed indexed annuities have been much better. It's just that all the big box shops out there want you to continue using their bonds. You've got people out there trying to scream at you as a marketing ploy that annuities are bad. So we've been countersold the word annuity all our lives. And then we have these salesmen pushing them down our throats at dinner seminars. That does not mean they're bad. There's great fixed indexed annuities out there. And as a safe investment, I have a hard time putting these up against anything else out there. I can't find anything better on the market. Okay, so we've got to understand that there's a stigma out there, but there's nothing wrong with fixed indexed annuities. Okay, used properly in a portfolio, they can be a very valuable tool. And if we're looking for safe investments, to be real honest, in the times that we're in right now, there's nothing better. Okay. And I don't see that changing anytime soon because I see plenty of volatility, not only in our stock market, but in our interest rates. So we've got to stay away from the longer term fixed interest rates. The hard part is those short term fixed interest rates don't really do much for us either. So we got to be careful about how we're investing safely. Let me know if I can help out. We look at this stuff all day long. I have no biases. I literally am licensed for everything. I am a stock market guy. I believe in the stock market. But the reality is some of us need safe investments, and that's what this update's about. We're talking about the choices that we're making on the safe part of our portfolio. And the people that need safe investments are the ones withdrawing from their portfolio. Everybody else, it's a choice. Okay, if you don't need your money, if you're younger and your money's still growing, you don't need safe investments until you start approaching that retirement age and you're actually going to need to withdraw money regularly. Okay, everybody else, Warren Buffett, everybody else, all these people that don't need their money, you don't need safe investments. This update is more about who needs those safe investments and what our choices are. Okay. So let us know if we can help out in any way. I'm sure I've got a report down below that's a wonderful report. Go ahead and click on that, subscribe, share with your friends, and I hope to see you next week. Thanks again.